Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. 10-year Treasury, 1.65%. So still moving down in here. And the question that should be on everyone's mind is from the standpoint of the investment portfolio and how it looks on an analytical basis. For instance, here is a bank that when we look at the different lines in the total return is that it shows with a move, this would be down interest rates, up 300 interest rates. How does that portfolio shift? And when we look at this, you can see in the down rate environment that it squeezes in terms of overall performance and total return. Interest rates go, of course, total return drops, but it drops at a much faster rate. This would be considered to be an off-balance portfolio. And many banks out there have off-balance portfolios, meaning that what will happen if interest rates continue to move downward is that they'll see more prepayments on mortgage-backed securities, on callable securities, which will then basically make their performance that much less for the investment portfolio. And what that is in terms of this blue line that you see going into the negative convexity. It's suggesting that those options are fairly heavy for this particular investment portfolio. So when you look at it in terms of where we're at right now, this may give you a chance to restructure for asset liability purposes, especially from the standpoint of looking both if interest rates continue to head down and then what will be the performance if interest rates head up. So if we did a sample in terms of restructuring on this particular investment portfolio, and let's say that we cut out this negative convexity and actually created less negative convexity in the portfolio. Look at the change compared to that in terms of the balance. And once again, this balance can be modeled. You can put in, what if I do this? What if I do this? What kind of impact will it have in those rising and falling interest rates? So once again, it's important to look at this in terms of trying to remove out as much of that negative convexity as possible, because that's going to come to hurt, especially if interest rates drop further. We have more prepayments on mortgage backs, as well as having large volumes of callable securities called, and then what do you do with the money? So once again, this may be a real opportunity to look at restructuring the investment portfolio so it's more in line with the entire bank. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.